This is the Nedgroup Investments podcast, where we explore a variety of views and insights that investors care about. Hello and welcome to the Nedgroup Investments podcast. I'm your host, Demisha Greater, and today I'm joined by Nic Andrew, the Executive Head of Nedgroup Investments. Nic, thank you so much for being here.
Thank you to me. It's a pleasure to be talking to you today.
Nic, today we're talking about an interesting topic. Now, the ABC of not meeting your investment goals. This feels like a shift from the things we usually talk about that focus on the habits and behaviours we should work on. Can you tell us what this means and why it matters?
Sure, Tumi. The ABC of not meeting your investment goals is a simple way of summarising 3 common mistakes that investors make that prevent them from achieving their desired outcomes. Charlie Munger, the legendary partner of Warren Buffett, always used to say when solving a problem, invert, always invert. He sought good judgment mostly by collecting instances of bad judgment and then finding ways to avoid such outcomes. So, instead of saying, what do we need to do to achieve our investment goals, we thought it would be interesting to adopt his approach and say, what must we not do? And there are 3 big things we identified not to do when it comes to investing. Firstly, being apathetic or overly anxious. Secondly, letting your emotions take over and making the most common behavioral mistakes. And finally, being overconfident and investing in a portfolio that is too concentrated.
I'm sure those will resonate with a lot of people, and the ABC each stand for one of the 3 things that we should not do, right? So let's start with A, which you say stands for apathy. What does that mean and how does it actually impact investors?
Well, apathy is a lack of interest or enthusiasm for investing, and it can manifest its way in a whole lot of different ways, such as not getting started, being too risk-averse, or delaying or waiting for the perfect time, which we all know doesn't ever exist. Apathy can be driven by fear, uncertainty, or inertia, and it really does get accentuated by the media, which thrives on negative headlines. The problem with apathy is that it can have a huge opportunity cost, especially over the longer term.
Nic, can you give us an example of how apathy can hurt investors?
Yes, well, let's say you've got 100,000 Rand that you want to invest for your retirement, which is 20 years away. If you invest in a balanced fund that earns 10% per year, and that's a reasonable expectation, you would end up with just less than 700,000 Rand. But if you delay investing for 2 years because you didn't get around to it, because of all the hassle, you would end up with about 550,000 Rand, or 20% less than you could have. Similarly, if because you're anxious of short-term movements, you decide to invest in a low equity fund instead of a normal balanced fund, which has a lower equity or growth component, your annual return over the 20-year period is likely to be about 2% per annum less. Over the 20-year period, you would earn just over 400,000 Rand, or about 35% less than you could have.
Oh, that is quite significant. So what can investors do to overcome apathy and anxiety?
Well, there are a few remedies. The first one is really what we're talking about, and just to learn from the examples above and understand the enormous cost of delay, the power of compounding, and the cost of not investing enough in growth or equity assets. The sooner you start investing, the more time your money has to grow and benefit from compound interest. The second one is to phase in your investments rather than waiting for the perfect time. This can help you get started and reduce the anxiety of committing to the market and then suffering a large, uncomfortable decline shortly afterwards. And the third one, and my favorite, is to set up a monthly debit order that automatically invests a portion of your income. This can help you pay yourself first. We are much, much better at committing our future self. And by doing this, we can really develop a very powerful and positive habit.
Oh, thanks so much, Nic. And that's very helpful. You've got to start somewhere, right? And now let's get on to the second mistake. B, in this case, stands for behavioral biases. What are they and how do they impact investors?
Well, behavioral biases are the psychological tendencies or simply our emotions that influence how we think and how we act, often in irrational ways. They can affect how we perceive information, how we make decisions, and how we react to outcomes. Behavioral biases can lead to suboptimal investment choices and performance, especially in volatile and uncertain markets.
Are you able to give us some examples of these biases and, of course, how investors can be hurt by these actions?
Yes, there are many behavioral biases, but the one that causes the greatest wealth destruction is investors and advisors switching in and out of funds at the wrong time. So investing after a fund has performed well and disinvesting after it has done poorly. Now, very few admit to doing this, but the industry evidence is conclusive. One of my colleagues, Sunay de Villiers, recently did an excellent piece of research where she looked at the 4 most successful and largest balanced funds in the industry. These are all excellent funds, superb track records of decades, well-respected teams, proven philosophies, etc. She analysed the fund's returns since inception, which varied from 13 to 28 years ago, and all had delivered excellent inflation-beating returns, somewhere between 12 to 15% per annum. But the average investor in those same funds earned between 3.5% to 4.5% less per annum. So, instead of earning 12 to 15%, the investors in those funds actually earn between 7.5% and 10.5%. That difference is huge and enough to change the comfort of one's retirement. This is a really significant and the main distinguishing factor between those returns is the timing of when investors invest and disinvest.
That is concerning and terrifying. What can investors do to overcome these behavioral biases that lead to this huge gap?
There are a few remedies that can help investors overcome this switching bias, which is very natural, and it's an industry-wide phenomena, it's a global phenomena, and it's been true for decades. The first one is to have a long-term view and stick to a disciplined investment strategy. This can help you ignore the noise and focus on the fundamentals. Switching managers just because of short-term performance is a really poor and value-destroying strategy. The research also provided some interesting insights. The more volatile a fund's relative returns, that means how much it varies compared to its peer group, the greater the behavioral gap. Secondly, that a simple fund that combined these 4 managers was much less volatile and accordingly suffered a much lower behavioral penalty, as did a low-cost diversified portfolio. Both the multi-managed and the low-cost portfolio's behaviour penalty was about half that of the 4 large balanced funds. Conversely, fad funds or highly specialist funds, and these are often launched with lots of marketing, often after really good recent performance, offer the largest behaviour gaps and should be, for the most part, avoided.
That's very insightful, Nic. Thanks for that. Now, let's move on to the third and final mistake. C is for concentration risk. Now, what are they and how do they affect investors?
Well, concentration risks are really the risks of having too much exposure to a single asset, sector, or market. Concentration risks can be driven by overconfidence, greed, or familiarity. The problem with concentration risks is that they can expose you to extreme losses, which are very difficult to recover from, especially when things don't pan out as planned.
Can you give us an example of concentration risks?
Yeah, sure. I think there are lots, but a really classic one would be in the Enron collapse, where many of its employees had invested 100% of their retirement funds in the Enron stock, which just devastated their investments when the stock collapsed after the fraud was uncovered. Less extreme examples include many investors getting sucked into the hype of meme stocks during COVID, which first did brilliantly, attracted lots and lots of investors, and subsequently many lost more than 90% of their value.
Oh, that's quite dramatic. What would you say to investors to avoid concentration risks?
Well, I guess the obvious one is to benefit from the only free lunch in investing, which is diversification, and to make sure you diversify your portfolio across different asset classes, markets, sectors, stocks, and managers. This can really help reduce the impact of any single factor or event on your portfolio and smooth out your returns. The second one is to avoid leverage or borrowing money to invest, because this can amplify your gains but also your losses and expose you to margin calls and liquidation. And finally, for those who couldn't resist the excitement, a practical solution is to have a small portion of your portfolio to satisfy your speculative needs and allow you to take specific risks. This can help you limit your exposure and avoid putting your entire portfolio at risk.
As they say, never put all your eggs in one basket. Nic, that was very informative and, of course, always engaging. Now, I'm sure our listeners have learned a lot from you today, but before we wrap up, do you have any final words of advice for our investors and financial advisors in South Africa?
Thank you, Tumi. And my advice is simple. Be aware of the common mistakes of apathy, behavioral bias and switching between funds at the wrong time, and concentration risks, and some practical actions to overcome them. Visit our website for a range of behavioral content and material that can help you have better conversations with your clients. Start investing early via debit order in a diversified portfolio with sufficient exposure to growth assets, and then stick to the plan. Keep a long-term view and be conscious that we all have emotions and that they tend not to be your friend.
Nic, thank you so much. And as always, very, very insightful. Of course, that was Nic Andrew, the Executive Head of Nedgroup Investments. This podcast is for marketing information only. The information contained in the podcast or video was for information purposes and does not constitute advice, recommendation, or an offer or solicitation to purchase or sell any funds or strategies to any person in any jurisdiction in which the offer, recommendation, or solicitation to purchase would be unlawful.